Quite a
Last,
cover.
lot to cover, that's for sure.
Right. All right. Well, my name's Neil Kane. For those that don't know me, followed up with my counterpart, Evan. We spoke last month about the markets, but a lot has changed since then. So we're going to have some good information to share to hopefully keep you guys from really tinkering too much around with your portfolios right now, because there's a lot unknown. But we're going to talk about what we do know. So, Evan, talk to us a little bit about what's going on in the market right now.
Yeah, definitely. And we picked a heck of a time to go from every other month for these market commentaries. So with everything going on, we decided to go back to at least one this month.
That's
But
right.
what's going on in the markets right now? As everyone knows, the markets are down, and that's a direct result of the tariff announcements that were on April 2nd. So if you look at the top left of the screen, year to date, and this is as of the morning of April 4th, so down a little bit more since then, but overall down between 15 and 20%, so almost entering into a bear market. So things have been plummeting. But if
Right.
we look at the 3-year on the top right of the screen, if we look at the large cap averages between 5 and 8%, still pretty normal. A little on the lower end of what we would want from stocks, but on the 3-year average, still being around 7%. We can still sleep at night with that.
Right.
The one thing that's interesting here is if we look at the international stocks year to date, up about 8%, which, as we know, international has been a little bit of a lagger recently, but that's why diversification is so important. Having exposure to different asset classes, being invested a little bit internationally has actually eased the blow a little bit here.
Right. And what it looks like, Evan, is like most of the punishment looks like it's coming on the growth side of the market this year, right? Where we're down between 13, 10, and 15 from large to small cap. Looks like the only saving grace in the whole US market right now is large cap value. And that may be because of more attractive P ratios on large cap value, where the growth has really surged in terms of P ratios. So talk to us a little bit about the P ratios that you're seeing and what you think about those, Evan.
Yeah, and that's what we've been preaching for the last couple of months, even year, that the PE ratios on the growth side have gotten a little out of whack. So if we looked at March 31st, a couple of days ago, those PE ratios going forward, we were actually anticipating a little bit lower of returns, somewhere between 5 and 6% in the stock market, because those PE ratios were so high on the growth side. So did we expect that the market was going to tank because of these tariffs? No. But also a little bit slower growth in the stock market was expected because of those PE ratios. So this kind of goes with the story that we've been telling and expecting. We just didn't expect it to come this way.
Right. A little bit more than what we would have expected so far. But the tariffs also came in at way higher than what the expectations were. So a lot of this could be a little bit over, an overreaction to the market, but not necessarily without due reason, because markets are spooked right now. We've also been watching unemployment, right? So unemployment has actually been super low for the last several years. We've seen unemployment really tick around this 4% level, which generally means that's a pretty healthy economy. And that's what we currently see here right now as well. However, if we do look at times in the past when wage growth and unemployment kind of equaled each other in terms of just netted out, what this meant was the economy was basically at these time frames becoming quite tight. Unemployment was super low, wage growth was super high. Therefore, the economy didn't really have anywhere else to go but down. And that's kind of what you saw here in '06 and '08, right? When those intersected. We see that again right now. So that's one of the things that's giving us a little bit of concern. But again, we're not seeing a huge surge of unemployment just yet. And I just say just yet, right? We're going to have some of those government jobs baked in to that unemployment. But so far, nothing super telling about this graph that gives us big concern. But there is a little bit of trouble when you start to see those converge. Evan, what do you see in terms of consumer sentiment right now?
Yeah, and this is the golden rule of investing, where it's buy low, sell high, and it's a lot easier said than done. Where when things are going great and consumer confidence is really high, things are green, green, green. It seems like a good time to get in. It's actually not a great time to get in. Where if we look at January 2007, right before the Great Recession, consumer confidence was really high. The next 12 months, the market was down. If you
Right.
look at 2015, when the stock market was going on a great run, things were green, people were happy. You put money into the market, the next 12 months, the market was down 2.7%. I think what we really need to think about here is what happened in COVID, where things were really scary. We didn't know what was going to happen over the next couple of months or year. People maybe pulled out of the market because of all the uncertainty. If you look at the 12 months after, the market was up 43%. Do we think that's going to happen here? No, but that's a telling story for the long run, where even when things are unprecedented and scary, it's not the time to sell off and get out of the market.
Right. It seems what we're seeing is in all kind of, let's call it one, if I started to count, right, 1975, consumer sentiment bottoms, get a 22% upshoot over the next year. 1980, consumer sentiment bottoms, 20% upshoot. 1990, and some of these were followed by recessions, but some of them weren't. In 2011, obviously that was not a recession. 2022, that was not a recession. We bottom in consumer sentiment. We're down to the levels in a lot of these cases where that coincide with recessions. We're here at 57 on a consumer sentiment reading right now. It doesn't get much lower than that. And to your point, Evan, I think the contrarian view of this is when we get super low on a reading on consumer sentiment, a lot of times that means on these 9 troughs, right, which is what's being counted up here on the left side, you got a 24% bounce the next year. Whereas when you get on the 10 sentiment peaks, we had a 39% 1 year return from there forward. So pretty interesting, kind of tell us that we ought to stick to our long-term goals as opposed to get spooked out of this more so shorter term freak out that's causing the market to kind of panic here over the last 2 days. So with that being said, I think I'll talk a little bit about oil. We did a little research in oil, right, Evan? We took a little bit of a peek back in history, and we wanted to look back because oil has really been a canary in the coal mine a lot of times when it came to recessions. In fact, when oil surged, right, and we got high readings in oil back in the 70s, back in the 80s, even back in the 1990s, these coincided with a lot of peaks in the market as well as recessions, right? We even saw a surge and a peak here in '08. We saw one in 21 when we had high inflation, right? But we are not really seeing high oil prices today. In fact, I just checked. I think oil's down to about $62 a barrel. OPEC released a message that they were going to be ramping up their production. So when it comes to that, that is, a positive kind of aspect to this is we're not seeing surging oil along with another kind of another problem like tariffs. We're just seeing right now in a vacuum, more so tariffs being the scenario that's pulling things down, but not oil contributing to that fear, which is a great thing, because if we look at oil's impact on inflation, it's had strong impacts on inflation. You don't have to look that far. In 1974, massive increase to the inflation rate. And that was foretelling you that oil was going to be on a surge higher. And really, we had double tops of inflation that were massive, above 10% on the inflation rate. So that is not what we're seeing today. We're actually seeing really reasonable oil prices. And when we look at the contributors of inflation, in the last go around on our highly inflammatory situation here in 22 and 23, oil, which represents everything here in green, was a pretty big contributing factor in that surge, right? When we look at that graph, we've got about a 4 to 5% increase over kind of what would have been more so of the baseline inflation had we not had that oil surge as well. So the fact that we're not seeing it, in fact, we're moving lower in oil over this last quarter, that's a great sign that inflation may be able to stay in check. But of course, a big part of that surge in 2021 was the section here in orange, which is core goods. And this is the part that I think is super scary in terms of what's got the market spooked is tariffs going to lead to inflation really on goods, right? We've seen that really be a non-factor here in 24, but does that come back? It may, but what we don't think will come back with it is energy prices shooting back up again, which should keep a lid on inflation from drastically spiking like we saw here in 2022 and 23. Evans, any comments to that before we shift?
No, I think you ended on the right point there, where we really got to keep an eye on the core goods, and that would be the main concern with inflation.
Right. Yep. All right. We dissected a little further. We moved into interest rates, and we wanted to look at how interest rates behaved when there was going to be economic pain. And we really wanted to look at what the federal funds rate was over the last 30 years to kind of look at what happened during economic events such as the dot-com bubble of 2000, right? Such as 2008, such as 2020 when we had COVID. These were pretty much recessions. These were major economic shifts that caused markets to tank in all three cases. And what we saw in response to that was a massive policy shift in interest rates. Interest rates were dramatically reduced in all three cases. Now, interest rates right now are sitting at a fairly reasonable top over the last 30 years. The expectation really is that interest rates will not go above this line that we just drew. But where we stand is about 4.25-ish on the federal funds rate. The expectation is to move lower. But of course, that is going to tariffs are going to cause a pause in that decline. But that may not be a horrible situation when it comes to not only bonds love interest rates stay higher, right? But also when yields decrease quickly, like when we talk about the 10-year treasury, which is pretty much a proxy for treasuries, right? And for interest rates, we normally will see a decreasing interest rate into a major economic environment. When we look at the interest rates over the last 2 years, these interest rates have remained fairly stable. We've seen a slight decrease over this year, but nothing to tell us that there is a significant economic decline coming, right? Not to mention, when we look at some of the other recessions that we've had, we saw interest rates coming down significantly leading into the dot-com '01 recession bubble there, right? In fact, we saw yields coming down for at least 12 to 16 months prior to that recession. So that was foretelling. Again, here in 2008, we saw yields sliding south, really almost starting in mid 2007. Again, not seeing that. Even in today's 2,200 point drop of the market, interest rates on the 10-year yield only fell by about 5 basis points. Okay. That is not indicative of a panic type of scenario where the economy is coming untethered and essentially the Federal Reserve is coming in or expected to come in to save the day. I don't think that you're seeing this here now. Of course, there's a double-sided part of this coin, which is the Fed may keep rates higher to keep inflation at bay, right? So it may act a little later than what it would have normally acted. But again, we aren't seeing the particular playbook of a recession take place right now in some of these areas. So that leads us to our next area, our maybe place that will work this year where it hasn't worked for several years. Evan, tell us a little bit more about fixed income.
Yeah, and I think going to your point where if the Fed does increase rates, right now they're in a wait and hold. If they do need to dramatically increase rates, which would be a worst case scenario for bonds, I think we're looking at a 2022 scenario where when we saw those interest rates skyrocketing, obviously we know inverse relationship between interest rates and bonds. As interest rates go up, the value of bonds go down, which is what we saw in 2002. And I think the worst case scenario for bonds would be something like that, which with all this volatility doesn't seem like too bad of a scenario where if the bonds are down 10%, not ideal, but as a worst case scenario, we would be okay with that.
Let me kind of play devil's advocate there, though, Evan, and let's talk a little bit about that. Remember in 2020, what caused that massive drop to the bond market? I mean, we went from a 0 to a 5 handle in less than 6 months. So that is the biggest increase to yields pretty much ever. So in order to get, you're talking about a 5x yield increase. In order to get a 5x yield increase from where we are on 4%, I mean, yields would have to go to double digits. That means you're having excessive inflation. So I think the risk of any sort of double digit drop on the market, on the bond market, is next to nothing. Now, to your point, does inflation cause a little bit of hiking and maybe a little bit of a hiccup? I think to the point that you were going to make on this chart, right? Bonds are already up for the year, right? Bonds are up nicely for the year. In fact, what are we at on bonds right now, Evan?
Yeah, bonds are doing what they're supposed to do when there's turbulence in the stock market. Bonds are the ballast. And if we look at the year to date, bonds are up, call it an average of 4%, which is really what we want our bonds to do long term. And do we see bonds as an opportunity for some security? Yes. And that's what I was talking about in the last slide. Even if the worst case scenario happens, that worst case scenario isn't too bad. But bonds are doing their job now, and we see them as somewhat of a safe haven going forward. And what those returns look like going forward are pretty similar to what we've seen this year so far, is with where the yields are currently are. We see them, the bond returns being somewhere in the mid 4% going forward, if we don't see anything crazy with the Fed's increasing rates.
Right. And again, I think the base case to that would be, okay, if the Fed had to go back to an interest rate hiking because we're where we're at on yields, I think that would have a uh, pretty muted drawdown to bonds, pretty muted. The reason for that big drop was really because of where we started, and we're starting from a much higher yield this time. But agreed, I think an expectation of 4.5% on bonds, given where we are, sounds really reasonable. So really, I guess we can conclude this video on, are we shocked at all the chaos in the markets? I wouldn't say super shocked, but I think it took us a little bit by surprise that the tariffs came in over the expectations, which were already pretty high. Do we see that as maybe as a negotiation tactic? We do. I think LPL, the consensus here with the research team is that a lot of this will be done for negotiation tactics. We don't know where this will settle out. We think it's a fluid type of situation, and therefore the emotional standpoint to react to these changes and change things is really something that we're encouraging folks to not do at this time, right? Staying the course, staying invested, and of course staying diversified is really the big strategies right now. But Evan, tell us a little bit about what's going on in volatility. Is this normal right now? When should we hit the panic button?
It seems like every year or every couple of years we're saying we're in unprecedented territory. It really does seem like every year. But I think we can go back to the uncertainty during the election, the uncertainty during COVID. Even there are some similarities to 08 right now, where people are spooked. We don't know what it's going to look like in the near term. But what we can say in the long term is that the stock market will go up. We need to just keep in mind that volatility is normal. It happens. I like going back to 2020 when COVID hit. The stock market was down, extremely down within a couple of months, but then it ended up the year positive. So
right.
The point is, we just can't make these knee-jerk reactions and move everything to cash if these funds that we have invested are for the long term.
And I think a point to make, as of I think close of today, which is Friday, April 4th, I think the S&P 500 is down 13% as of right now. Could be down a little further. That was before the bell ended. Might be down 14. But bottom line, the average decline in a year going back 45 years is 14%. So we're approaching the average decline in all of those 45 years. And 35 out of those 45 times, the market ended up positive. So even with a 14% correction. So if you think that this feels different, yes, it feels different because it's a different situation. And we've had these situations in the past, right? We've had these situations where the markets go down significantly, and we've had even bear markets, right? But at the end of the day, markets have proven to be resilient. And you know, I think you made an interesting point on some of these last time, Evan. I don't know if you want to talk about any of these instances in particular, but each time it feels different, but it's one and the same when we look at the bear markets, right, that we've seen in the past, and the recovery and the duration for how long these markets last are all over the place. Let's be honest. However, they're not that long. I mean, if we look at the duration of some of these, what is the average duration in here, Evan?
I think it's about 1 year, 1.2.
Okay. 1.2 is the drawdown. And then followed by multiple years of recovery. So if we look at 1 year later from some of these big drawdowns, we're up 45% 1 year later from the bottom. Is that what I'm seeing?
Exactly.
Yeah, I mean, So this is kind of what we're talking about, is still keeping that long-term perspective. Now, I know for some of you, you just transitioned in retirement or you're nearing retirement. For those folks, we've carved out, at least folks that we work with, significant portions of portfolio to either be in bonds or to be in something that protects principal, like the notes that we've been using for some clients. So what we want to make sure is that the cash needs for clients during this volatile period and potential bear market, we don't know. A bear market's defined by a 20% drawdown. Does this stop at the average at 14% and turns around? We don't know. And I think things could quickly change, right? Based on a different direction on tariffs. So that's how fluid the situation is. But bottom line, as long as you have ample amount of safety in that portfolio that you can utilize for the next few years, we should be out of the woods by that time frame, right? We don't know how long this will go for, but these times in the past have not been very long before the market sniffed out recovery, a change in economic path forward, and really, a better result for investors. So anything to add, Evan?
No, I think you nailed everything.
Awesome. Well, I think that's the majority of our presentation today. We'll leave kind of the slide where we ask folks to, we had a few tidbits here in terms of focusing on fundamentals. I don't know if you want to throw anything in here, Evan, on this slide.
Yeah, just a couple of final thoughts where the market is flexible, it's adaptable. When these crazy things happen, the market seems to adapt and overcome. You already mentioned that there's all these tariffs might have been a negotiation tactic. So we'll see what happens there. And with all this volatility, diversification is important. As we've seen with the international stocks, those have helped lighten the blow. And also bonds have been performing well. So that's why diversification is important. And the long-term vision that we're talking about is we're really relying on American innovation, where we think that the US companies will continue to innovate and growth looks good for the long term.
Awesome. All right. Well, thanks for watching our video today. We will be keeping a close eye on things as they unfold. We may even have an extra video if there is more volatility for the month of April. We'll see. But until then, try to tune out the noise as much as possible. Reach out to us if you have questions. If you have any sort of scenario where you need assistance, please reach out. We can always get on the phone, get on a quick meeting with you to talk about your individual investments and portfolios. So until then, have a happy start to spring. April is here. That means April showers. I don't know if it's raining where you are, Evan. It is here in Virginia.
Little gloomy. No rain, though.
Got it. Well, awesome. Anything else to share before we get off?
No. Looking forward to the Final Four this weekend.
That's right. Maryland got ejected, so was a little bummed about that, but it's all right.
They had a good run.
I think all number one seeds.
All number one seeds.